Hi everyone, this is Paul Lang from Disciplined Trading Strategies with a bookmark on the market, part 3. This is October 17, 2018. This is being recorded. I have done 2 of these prior to this. DTS has been around just over a year now, so that's the 3rd one in just over a year. This is looking at the big picture of the U.S. stock market. Let's get right into it and take a look at what I have to say here. I call this a bookmark on the market because I wanted to just freeze a moment in time here and review what my comments have been so there is no question in the future. It's very common after a major market move that all of the great pundits out there are explaining how they were right in some abstract way or another. That's in the beginning of every one of these. This is my 3rd one. The first one was done January 30th, 2018. The second one, July 16th. You may want to watch those as there are comments and lessons that apply today, even though the market call is old. Whether you're watching this on YouTube or on the DTS site, if you look a couple of videos to the left, the miscellaneous video section, you should see the others if you want to watch them. The main discussion point in this video is the reason for the change in bias to some extent on the morning of October 2nd, which right now was about 2 weeks ago. I want to remind you of something. This video and other bookmark videos are explanations and are meant to capture my comments so that they are in stone. The timely calls come out to DTS subscribers of the DTS Market Letter, Long-Term Trader, or Trading Room. The comments featured here were from these 3 services and occurred on October 2nd. So now I can stop reading the slides a little bit and start to talk to you. The time frames that I look at when I'm analyzing the market are always 3 time frames, and you see them right here. They're the intraday outlook, the midterm outlook, and the long-term outlook. The intraday outlook is a day trading outlook. It changes from day to day. It's not relevant to anything else. We could be in a very bullish market in general, but have a very bearish outlook one particular day. The midterm outlook is the one that looks out to the next several days to several weeks. It is one that is important if you swing trade or core trade, because you don't want to be fighting this for the most part. The last one is the long-term outlook. This is the big one. This is the monthly and weekly charts. This is, hey, I've been in stocks for years. Is it time to dump them? This is trying to avoid 2001 and 2008. That's the long-term outlook. The long-term outlook, just to be very clear for me, has been max green for 10 years now, and is not changing today. Listen carefully to some of my comments, however, but that is staying here. It's the midterm outlook that had the big change. Let's take a look what happened here from October 1st to October 2nd, Monday to Tuesday. And again, this is published before market open on October 2nd. The midterm outlook went to very bearish. Intraday, we don't care, that doesn't matter, but the midterm outlook went to very bearish. Now, that's not an insignificant thing, because the last time it was read was one day on August 2nd, which it didn't need to be, and before that it was quite a while before that. So this is not something that happens all the time. This one also, I'm doing a video at this point, obviously because I think it's a little bit more of a significant one than some of the others. I will explain why. The comments that accompany this, again, were clear and unambiguous language, not just random thoughts. I'm going to have a mildly aggressive change of the bias today based on what's happening over the last 2 weeks, including yesterday. I feel there's a good chance the market will be grinding sideways for a while. The long-term bias, of course, does not change. That's this one right here. But the midterm bias, I have moved to bearish, expecting at least the retest of the 180 area in the QQQ. That is what the midterm is for the next several days. If we get there, it is also possible we may see a test of lower levels on the weekly charts like 174 to 176. Well, it did not take long for that to happen. This is the 174 area right here. We hit it a couple weeks later. We went lower for one day, and then we came back. And of course, since then we've been higher. This chart was captured a couple of days ago. This is October 2nd, to be clear. It's that topping tail day right in the middle of those 3 red bars. So the morning that I did this, this bar formed after I did this. This was the next day, and then 2 days later we gap down a little bit and the debacle begins. We fall, a very faint bounce, and then the biggest red bar on the chart in a long time, a bottoming day, and right now we're moving back higher. I'll discuss the implications of that in a moment. Let's take a look at what I was looking for. A lot of people who have emailed me, who follow as a free member, and even some people who have taken courses or in the room or take the letter from me, have asked the question, what exactly were you looking at? Also, at the same time, in the DTS long-term trader, that's what that stands for, it issued its first short core play, which already hit a first target in conjunction with that bearish market call. Before I explain, I just want to give you something to laugh at a little bit. If you want to have some fun, Google Stock Market Outlook for October 1st, 2018. First of all, you will find a bunch of non-committal calls. You know the ones. They're the ones that many years ago I used to listen to and try and figure out until I finally realized that these people are really saying nothing. They're the type of calls that say, well, the market's very strong and it has been looking higher and it continues to look higher, but we are coming into FOMC and we're coming into earnings, and if the market reacts negatively to these, then the market will fall. Well, at some point you're going to realize that 90% of the comments you're reading are not helpful at all. They're just non-committal comments. And what was funny was on this day, there were some places that decided to finally switch over to a bullish bias. About the same day that I went to a bearish bias. It's kind of funny how that happens. It's the second or third time it's happened this year. I want to make a note, a quick comment here to students of the market. I'm talking to anybody who's been studying the market for a while. I'm also talking to my own students. I'm talking to anybody who has been trying to figure out the market or figure out why this happened or why I made this call. I've gotten many emails from people asking, how did you know this was coming? It was right on. What happened? What made you think that way? And some people who have been studying the market for a while, and possibly even my own students, said I just didn't see this. Well, I don't want you to feel bad, because I believe that if you want to learn to make money in the market, if you want to learn to trade stocks, to trade Forex, to be able to understand price action, I believe you can learn it in approximately 3 seminar cycles. And by that I mean I teach 3 seminars back to back, 3 Saturdays in a row. I do it every 6 weeks. So if you go through that process 3 times, and yes, I think you need to hear them 3 times to really understand it. It's about 18 weeks. And I think at that point you will be capable of being able to make money. However, some of the fine points are things that come with some experience and some seasoning and some understanding, and they're very close calls sometimes. And I don't think anybody who's been a student of the market for a short time should feel bad that they didn't see this coming. It was a very close call, and it was a nuance, and it's kind of like a balancing act. It's like being a judge in a court trial where all of a sudden a certain amount of evidence piles up and it tips the scale and you go, that's it, guilty. And that's kind of what happened here, and it had been building up for a couple of weeks, and it happened, and that morning I decided this was it. Let's take a look at the things I was looking at. I will be very specific. This is the QQQ daily chart. This section over here says, first of all, the market in general. On a day-to-day basis, I look at the QQQ and the SPY as representative of the market. Let me talk about that for a minute. That is the market. I tend to put the QQQ up as the primary chart. It really doesn't matter which one you want to look at. Some people think that I'm fixated with that or that makes a difference. It really doesn't matter. What you need to understand is that when the QQQ and the SPY are moving together in lockstep, then it doesn't matter what you look at. It's all just academic. When they are moving in different directions, you need to understand why and see if it's a significant reason or not, or what the consequences are. I never look at the Dow as the market. It's 30 stocks. CNBC, etc. all have their reasons for always quoting the Dow. Don't use the Dow for market analysis. On a regular basis, not every day, I will look at the IWM, that's the small cap index. I will look at sectors and sector rotation, and I will look at the VIX, that is the volatility index. Do not overuse any of those things mentioned here, the IWM, sectors, or the VIX. They have a unique purpose, and I do not look at any indicators or other external information. I have come over a long period of time to really just focus on price action. I know there's a lot of stuff out there other people want to look at, McCullen oscillators and this and that. In general, technical indicators are bad things to look at. I'll just say it that way. I know some of you may like some or use some, but they are not going to solve the answer for you. Technical indicators are the group of things that look at past price action, average it, or do some manipulation with past price data, come up with a new line and project it forward. There's a certain use for that, like moving averages are technical indicators, but it's a very limited use, and it's never going to predict the future for you in that case. There are some things that are not technical indicators that have some value, and they're what people tend to call confirming indicators. I think confirming indicators are simply a way of being wishy-washy. They're a way of being able to deny the truth or to not act or to be focused on inaction. I rarely see them help people. Confirming indicator means, well, I have this thing here, and gee, if price action is going a certain way, and if this agrees, that'll make me more likely to agree, and if it doesn't agree, then I'll be more likely to disagree. I think for the most part, it confuses people and gives them a good course for inaction. After a long period of time, I've come to focus on price action as being the sum total of everything that's going on, and when you understand it, little else helps you. Price action does include looking at all the different markets. And I do think the VIX has a certain purpose, but people overuse it and misuse it tremendously. Let's take a look at all of these things here. So the QQQ was actually lagging the SPY a little bit through here, and then it played catch up, hit the prior high. Now hitting the prior high is not a big deal. It happens all the time in an uptrend. It's expected. Let's switch to the SPY. That's what happened after, of course, the second. Let's switch to the SPY. The SPY had a little different pattern. The SPY was leading and made a little peekaboo pop. Now I use the term peekaboo, it's just kind of a funny term. I don't actually use it in my seminars or anything like that. It's just a term that everybody understands. But there is a significance to it. A peekaboo means that you pop to a new high and the new high got sold. Now there's a difference between a profit-taking move and a selling of a new high. There's a big difference in many cases. And a selling of a new high can happen from time to time from sector to sector, but you have to be careful when the norm becomes selling a new high. Because then the issue becomes that we are not selling just as casual profit taking, we are selling as in big money selling to begin winding down of positions. Now this is a little minor event that happened here, but the QQQ and the SPY, all of a sudden nobody was leading because the SPY was leading, the QQQ hit the prior high installed, and the SPY had made a new high and failed to follow through. That was one day to a new high and then immediately reversed for 5 days. So on October 2nd, the SPY looked like that and went like that. Now, even here again, just looking at the markets maybe gives you a moment to pause and question it, but still really not enough to take action. However, let's keep looking. The IWM, here's where I pull this up once in a while. The IWM, the small caps. Again, don't overuse this, but a good general rule is that the IWM lags on the way up and leads on the way down. Look at this chart. Look at the last several months, several years. The IWM was really screaming here. This was October 2nd. This was before the market started to collapse. The IWM was no longer in a nice uptrend. It no longer had that sideways pattern. Somewhere in here the last 2-3 days, it accelerated below a level it should not be crossing. It means that small cap money is typically the more aggressive money, the more risky money, if you will. And when the market is moving up from lows, big money pours into the big names and the big caps, and then when they get overbought, money looks for a new place to go. It hits the small caps. Well, conversely, when things are getting to lofty levels, people want to get out of the riskiest stuff first, the small caps, and they tend to lead on the way down, and that's what we saw here. That's a big oops. That's a big heads up, and of course, this had been slowly happening 3 or 4 days before October 2nd. And they also fell hard, which is important. It's not like money rotated out of the SPY and the QQQ and found a place in the small caps. The small caps were sold as well, another big clue. This happened a couple weeks before October 2nd, but these were all things that I said had me thinking. October 2nd is right here. This is the financials. This is the XLF. XLF powered to a new high in the middle of what should have been a nice bullish market and got whacked. And this was a big sign to me. These were the financials that tried to go to a new high. It was a significant breakout. And rather than pulling back a little bit or getting a little profit taking, it got whacked. That shows money leaving. Now, where did that money go? Well, it didn't go anywhere for the first time in a long time. This is the concept of sector rotation. Profit taking and moving profits from one sector to another is bullish, even if the sector gets hit hard, as long as it is still profit taking. But selling new highs is not profit taking, it is fear. And when that money has nowhere to go, we start to see things drop. And that drop is in a way that's not going to be a profit taking quick recovery drop. It's in a way that's going to have a little bit of a snowball effect. Look at the weekly chart of the financials. They hit a high back here and they have not quite recovered. Now that's okay, any one sector can do that. But let's look at a couple other sectors. And again, the financials got hit hard after October 2nd. SMH, the semiconductors, another big sector and a big part of the tech and the NASDAQ. The semiconductors also were struggling here through the latter part of the year, not able to make new highs, which is okay. You can consolidate after a big move up like this, big move up, new high. Consolidate's fine, but all of a sudden we come in here and we see again the little peekaboo top, a big rally to a new high. That's fine. You pull back, you make the new high again, and you get whacked. Now again, this is all 2 weeks before the October 2nd decision. Going into October 2nd, a weak rally, topping tail into this area, just can't quite get a handle on getting money brought into the semis either. Boom. The IBB, the biotechs, this has been a very strong sector. Now this chart doesn't look bad on the daily. This didn't really have any telltale signs. This is perfectly normal to have the big run into the prior high and to pull back a couple days. But the weekly chart, a little bit of the same thing. You see the weekly chart here, retest the prior high, stall, pull back, perfectly normal, perfectly fine. Pop to a new high, get sold, perfectly fine. But then come back to retest that high and then fall apart. That's not what you want to be seeing in sector rotation. The VXX, this is the volatility index. Actually, the volatility index is the VIX. This is the VXX, which is a cousin and close enough for the discussion here. This was not helpful in any way, shape, or form, not part of my decision whatsoever. It's become a pet peeve of mine that people don't understand and have misused the VXX. The VXX did this afterwards, but this is not helpful at all. Again, that's what it looked like October 2nd. That tells me absolutely nothing. Now people will say, oh Paul, the VXX was so helpful because look what it did. No, the VXX didn't make the market move. The market made the VXX move. It's the dog wagging the tail. This was not helpful at all. Now, the VXX, the volatility index, can be helpful in some ways, but it is not helpful in this situation and rarely is. It's more helpful in situations of complacency and a couple other uses, but this was not helpful at all. It is not something that should be looked at really on a day-to-day basis, and it should only be something that's used when it has a certain pattern compared to the market, and it did not exist here. That's my story for you for this time. I want to talk about three quick things: the balancing act, the snowball effect, and my bias in handling this. I talked about this already a little bit, that in making decisions like this, it's a balancing act. There is no magic potion, there is no magic line, there is no magic indicator, there is no number, threshold, support level. There is no one thing like that that makes your decision. This was a decision I made that was fairly unique to recent times. I have been very bullish. I want to emphasize again, if you watch the other Bookmark on the market videos, that I am by nature a bearish person. Now naturally, I'm a pure technical analyst, so I look at price charts and I will keep my bias in line with where price charts are, but my gut, my intuition is to be bearish. I agree with you, the market is crazy. I agree with you, the market is insane, but I have been extremely bullish and continue to be and have been for the last 10 years in the big picture. Now, this move here, of course, again, as I emphasized in the beginning slides, is in the midterm picture. It means that dropping to levels on the weekly chart, struggling, going sideways a while. However, I do want to point out, if you saw the other videos, that there are three ways that the market can make a major top. I'm talking about the big picture now. Those first two ways are not happening. The third way, however, is not quite as easy to discover, and it is possible that the next video I do could look back to this moment in time and say, you know what, that is the top. Now, I don't think that's the case yet. I'm not making that call, but it's possible it could lead to that. I think for right now, we're going to lead to a sideways, sloppy market on the weekly chart. And that's a market environment I actually love quite a bit. And I'm going to handle it by focusing more on bearishness on rallies, even in the midterm picture. In other words, swing and core shorts on rallies on weaker stocks. And how you do that is an art in itself. You have to listen to another video about that or come visit me on the Monday night biweekly scanning sessions. But there's a way to do that as well. But I'm not going to focus so much on being long in the pullbacks, which is a change in the first time that I've done that since 2016. There is a snowball effect, and when you are looking at the market to drop, it drops very quickly, and you have to be very sharp and astute in deciding these moments, because by the time a lot of people realize that we are falling, we've already fallen, and it's too late. This was 2 days before we fell, and if you waited too long, obviously we fell very quickly, and at this point in time, after today, we had a very bullish day today. I was very bullish today on the intraday pattern, and I think the rally will last for a couple more days. We had a couple of good days here. Actually, it was yesterday was very bullish, excuse me. Today, the 17th, was a little bit of a more neutral day. So that concludes this bookmark. Feel free to email if you have any questions. You can find me down there at the bottom of the screen, disciplinedtradingstrategies.com, and my email is Paul, P-A-U-L, at disciplinedtradingstrategies.com, or just visit the website and you'll find places to access me. Until next time, everybody, this is Paul for DTS. Good trading, everybody.